Hello class, and welcome to chapter 15, where we're going to talk about distributions to shareholders. So we're going to look at how companies distribute profits to their shareholders in the form of things like dividends and also stock dividends, splits, and repurchases. So dividend policy pertaining to a company is the decision to pay out earnings versus retaining and reinvesting them. And we can have many different dividend policies, and when you look at real companies and actual stocks, they can run the gamut from things like high-paying dividends to very small dividends. They can be stable, meaning they change very seldom over time, or irregular. You may get a large dividend one period and none or a very small one the next. How frequent do companies pay them? Some companies pay them yearly, some companies pay them twice a year, some companies pay them quarterly. And how are they going to announce this policy? So it was argued by a pair of economists named Modigliani and Miller that dividends weren't really relevant to determining whether someone would invest or not in a company. They argued that investors are indifferent between dividends and retention-generated capital gains. Now, dividends are pretty straightforward. We've covered them already. That's when a company takes part of their profits and pays them out as a cash payment. But a lot of companies don't pay dividends at all. They reinvest their profits to grow the company. So even though you may not get dividends, a stock like that should grow in a capital gain sense. The price should go up. So if you would get the same return between getting cash dividend payments or your stock growing, you really would be pretty indifferent as to what one you got. If you want cash, you could sell that stock that went up to pull out some cash. If you don't want cash, you can use dividends to buy more stock. So you could make your own dividend policy in that sense. But in reality, this may not actually be true, and the reason is tax purposes. So if we look here, why do investors may prefer dividends? Number one, a lot of investors think dividends are less risky than potential future capital gains. If your company is paying a steady 5% dividend a quarter, while yes, it can change in circumstances, usually, and we'll see why in a few slides to come, this often isn't the case. Dividends are usually pretty stable. Whereas capital gains, a company can be doing great, their stock can be flying, but next year it may go down. There's no guarantee. So if this is true, investors would value a high dividend paying company more. A high dividend payout would result in a higher stock price. Now, why might investors prefer capital gains? Number one, they may want to avoid transaction costs. So dividends may have a cost, depending on how the company is set up. If it's an international company, there may be fees when you get your dividends. Or if you use those dividends to buy more of the stock, there may be costs as well. That's not really a problem as much anymore. Most retail brokers have no transaction fees on stock purchases. The number one reason, however, is taxes. The minimum tax rate is the same on dividends, but with two large caveats right here. If your company is paying out dividends, taxes are due the year we receive them. So if we got $100 worth of dividends this year from a stock we owned, that gets added into our overall income when we pay our income taxes. We have to pay the taxes on the dividends immediately because the dividends were paid to us. However, if instead of dividends you have a stock that's appreciating in a capital gains sense, the stock price is going up, until you actually sell that stock, you're not going to be responsible for any of that unrealized gain. We may be up $10,000 on a stock we own, but until we sell it, we don't have to pay taxes on that income. Also, if you hold the stock until the date of your or someone you inherit's death, whoever the beneficiary is can use that death date as their own cost basis and escape all previously accrued capital gains. So if your grandmother will do a stock, and she bought it at $1 a share and it's now $100 and she made $100,000, you're not responsible to pay taxes on any of that $100,000 because your cost basis is the day you inherited it. So for tax purposes, a lot of investors prefer unrealized capital gains because dividends are a cash payment. Once you get a dividend, you're responsible for tax on that dividend. So what would we say is the information, content, or signaling hypothesis? Investors view dividend increases as signals of what management's view of the future is. Managers really hate to cut dividends. It sends a really bad sign. If you've paid a regular 5% dividend for years and now you slash it in half, it looks very, very bad for your investors. It makes it look like the company is in some sort of distress, and as a consequence, it's going to be a pretty bad red flag. So unless they absolutely have to, they're in bad financial straits, they're very seldom going to cut them. As a consequence, however, they are not going to generally raise them unless they think that increase is sustainable. For the same reason, they're not going to raise dividends for one quarter and then have to be forced to cut it next quarter, because that's going to send a very bad signal than of just leaving the dividend constant. However, a stock price increase at a time of a dividend increase could reflect higher expectations for future earnings per share and not necessarily a desire for dividends, so keep that in mind as well. Clientele effect, and I can guarantee you'll see some homework and or test questions on this. The clientele effect are different groups of investors or clienteles prefer different dividend policies. Every investor is different. Depending on what your goals are, your age, what are you investing for? Are you investing for retirement? Are you investing to speculate because you're young? What are you doing? Every investor has different dividend policies that they prefer, and that's our clientele effect. And you would argue that their past dividend policy of a company is going to determine its current group or clientele of investors. So investors generally will self-select. If you want a stock with a high dividend, you're going to find one and put your money into it. If you want one that has got a good potential for high capital gains growth and no dividend, you'll find stocks like that. So generally, the people who purchase stocks want to purchase a stock with those characteristics. But the downside is clientele effects impede changing dividend policy because your investors are comfortable with what you're offering, and it is not in their best interest to change. There's taxes, so if your stock completely changed the dividend policy and you want to sell it, now you're responsible for taxes if you made anything, brokerage costs. So it hurts investors who have to switch. So due to clientele effects, companies are very seldom to change up their dividend policy very much. And what is catering theory? Well, this is a theory that suggests investors' preference for dividends varies over time, and corporations will change their dividend policy to cater to current desires. The company is going to match their dividend policy to what their investors demand. Pretty straightforward. Corporate managers are more likely to initiate dividends when dividend-paying stocks are in favor. If growth stocks are in favor, they're probably going to emit dividends. So what is the prevailing sentiment of investors? Are they looking for dividend-paying stocks or not? Companies are probably going to adjust to meet those needs. So generally, dividend policy follows the desires of the investors in these companies. What's our residual dividend model? And we're going to take a look at this. This is where we find the retained earnings needed for our capital budget or to fund operations, pay out any leftover earnings as dividends, and this policy will minimize our flotation and equity signaling costs and minimize our weighted average cost of capital. So dividends in this model equal net income minus how much of our capital structure is equity, or our target equity ratio, multiplying our capital budget. So this is the formula we're going to use. So if we have $600,000 of net income and an $800,000 budget, 60% of which is equity, how much of the forecasted net income should be paid out as dividends? We're going to take a look at this on the next slide. So 60% of that is funded with equity, or $480,000. If we take that away from our net income, we have $120,000 available to be used for dividends. So that's how much would be paid out if we're using this model. And to calculate our payout ratio is simply divide the monetary amount of dividends by net income, or get 20% here. 120,000 over 600,000. Now the residual dividend model is quite easy to use. As you can see, it's a simple calculation, and you're welcome to use Excel or your calculator when it comes time to work on these. But it's not only the only dividend model we are going to use. But let's take a look at another example of the residual model right here. So what if our net income fell to $400,000? If our net income fell to $400,000, we still need $480,000 for our equity needs. We now have a negative $80,000 worth of dividends. You cannot have a negative number for dividends. That means there is no money to pay them out. So we're going to need to use all of our income to fund our operations and probably need to issue more equity to maintain this capital structure. If we don't do that, we would have to issue more debt, but either way, we're going to need more money. So we have no money to pay out. If you get a negative value for dividends, your payout is always 0%, no dividends. The reason being, we simply do not have the money to fund them. If it went to 800,000, it's the same formula, but now we have 320,000 to disperse as dividends. Our payout ratio is jumping to 40%. So this is a very easy formula to use, the residual dividend model. And once again, if you get a negative number for dividends, payout is 0%. You're never going to issue dividends if there is no money to pay them with. So how do change in investment opportunities affect dividends under this residual policy? If there are fewer good investments, we'd have a smaller capital budget, therefore more money to pay out as dividends. More good investments, less money to pay out as dividends. But why isn't the residual policy the only policy we may use? Well, what are the advantages? It minimizes new stock issues and flotation costs, so it's going to reduce our weighted average cost of capital. But it has a lot of disadvantages, and most real-world companies do not use this policy due to these disadvantages. Here are some of them. It can result in variable dividends. So if we did really good, like when we had $800,000 in income, our payout ratio was 40%. But if our income was $400,000, we had 0% dividends. So our dividends may be highly variable. We may pay out really large dividends in some periods and none or very small ones in others. And if we think back to a few slides ago, investors generally self-select into dividend policies they like, and they generally aren't very happy when they're cut. So we're going to be sending mixed signals to our investors. If we up the dividend one quarter, it may look like the company's doing great. Then if it gets slashed the next, the company is going to look like it's doing bad. Our investors aren't really going to know how are we doing and why is our policy fluctuating all over the place. It increases risk because if you know your dividends are highly variable, that alone is an increased measure of risk. You don't know how much of a return you're going to get at any point in time. And it doesn't appeal to any specific clientele. It's pretty hard to self-select into a stock that has this variable dividend policy that we don't know if it's going to be high or low or none. So there's no one clientele that is going to really be attracted to buying that stock. So the conclusion your book makes is consider this residual policy when you want to set a long-term target payout, but you really can't follow it rigidly from year to year for all of these disadvantages. So there really isn't any company rigidly following the residual policy, even though it's easy to calculate and it makes a lot of sense logically, due to human nature, the things like clientele effects and all of that. So how do we really set dividend policy if we are in charge of a company? Number one, we're going to try to forecast our capital needs over a horizon, generally around 5 years. We're going to set a target capital structure, and there's no right or wrong answer there. It all depends on the company, how much debt, how much equity. Estimate what our annual equity needs are, and then set a target payout based on the residual model. So we use the residual model to help us forecast, but we're not going to follow it rigidly to the letter. So generally, some dividend growth rate emerges, and you want to maintain a target growth rate if possible, even varying your capital structure somewhat if necessary to maintain that rate. So you want consistency in your dividends. You'd much rather vary your capital structure a little bit and make sure you have consistency in your dividends than have them fluctuating all over the place. A lot of companies use what's known as a DRIP or a dividend reinvestment plan. You may have encountered this if you own a dividend paying stock and check the button on your brokerage to reinvest your dividends. And a dividend reinvestment plan, if you enroll in it, you're going to automatically take your dividends and your brokerage will reinvest them into new stock shares. It's going to buy more shares of the stock with your dividends. Dividend reinvestment plans are really nice because think of compounding. Every time you buy more shares, now you're going to get more dividends, you're going to buy more stock. So you're going to add a slowly exponential growth of more shares. It's a very nice thing You're going to buy more shares, get more dividends every single pay period. So you're going to get more stock than cash. Tax-wise, it's the same. You're still treated the same for taxes because you got the cash payout and then used it to buy stock. But it's a way to roll your dividends over into more stock shares, and then those more shares will pay more dividends, so on and so forth. And there are two types of them. An open market plan is going to your broker is going to use your dividend to just purchase more shares on the open market, so just shares that are available. Or new stock, you're going to be buying new shares of stock issued by the company. So an open market plan, dollars to be reinvested or turned over to a trustee. That's usually your broker like Schwab or E-Trade or whomever you use. And they then buy shares for you on the open market, and now you have more shares. Brokerage costs are reduced by volume purchases, and they're convenient, easy way to invest and useful. So very useful. You can roll your dividends over into more stock. A new stock plan is where the company itself issues new stock to enrollees in the dividend reinvestment plan, usually at a discount from the market price. Then the company keeps the money and uses it to buy more assets. So it's a way to sell more equity. Firms that need new equity capital will do this. It's a way to issue more shares and raise more equity capital. Generally, firms that don't want to issue new shares are going to use those open market purchase plans. Most New York Stock Exchange listed companies have a dividend reinvestment plan. The overwhelming majority do, and they are useful for investors. Because a lot of investors like that, being able to roll their dividends into more stock, and then you're now going to get more dividends on your increased shares and all of that good stuff. So dividend reinvestment plan is highly utilized. Now, stock dividends and stock splits. These are other ways companies can pay out additional profits or modify their stock in some way. A stock dividend is where a firm issues new shares in lieu of a cash dividend. If it's 10%, if you have 100 shares, you're going to get 10 more shares as a dividend. So a company will announce this just like a cash dividend, only instead of getting cash, it used to be dividend checks, now it's electronic, but instead of getting a payment, you're going to get shares. A stock split is where generally companies that have a very high share price do what's called split the stock. And it generally will increase the number of shares outstanding. You can have reverse splits, but they're uncommon. More than likely, it's a positive split. So a company is trading at $100 a share, and let's say it splits 4-1. You had 100 shares at $100 a share, or $10,000. Now you have 400 shares at $25 a share. Still $10,000. So no value changes immediately. However, you now have more shares. So it's going to increase the number of shares outstanding and cut the price by however much they were increased. So stock dividends and stock splits increase the number of shares outstanding, dividing that pie into smaller pieces. Unless they convey any kind of information, the stock price is going to fall to keep everybody's wealth unchanged. So if everybody gets a stock dividend, everybody's stock price is going to fall a little bit, but you have more shares, so no value is really created or destroyed. Same thing with the stock split. But doing this may get us into what's called an optimal price range. A lot of companies with very expensive stocks are going to want to split that stock because it allows them to get their share price down, and as a consequence, their share price comes down. It makes it easier to invest. If the stock is $1,000 a share and now they 10-to-1 split, it's a lot easier for people to buy a $100 a share stock than one that's $1,000 a share. And it may get it into an optimal price range, leading to more growth. Stock splits have become less prevalent, but they are still fairly highly used. GameStop was an example of one about a year ago or a little more. Many investors pay transaction costs on a per trade basis, making the actual stock less relevant. Apple was another stock split that was several years back. Tesla about 3 years ago. So they do happen. So stock dividends and stock splits, once again, no value changes immediately, but it can get that company into an optimal price range and can lead to growth going forward. Stock repurchases are another way for companies to use their profits. Instead of paying out cash dividends, they can do what's called a share repurchase, where they buy their own shares back from stockholders. If you do this, think of economics. You're reducing the supply of stock. that should drive the price up. Even if demand for it doesn't change, if there's less shares, the price is going to go up. So instead of paying cash to your investors, if you buy back some of your shares, in theory, you're going to raise the value of their shares they keep. So it has the same effect as a cash dividend. They may not be getting a cash payment, but now their stock is worth more. You're increasing their wealth. So number one, this can be done as an alternative to distributing cash as dividends. Instead of paying them cash, you're going to drive their share price up. Also, they're not going to be subject to taxes unless they sell. So that's another thing that's attractive to your investors. You can make a large capital structure change. Let's say we have way too much equity capital and we want to reduce some of it. Buy back some shares, we reduce our percent of our capital structure, that's equity. Or a lot of times companies will do that if they need stock to use. Remember back early on we talked about things like stock options and how they can be tied to corporate pay. If you owe your CEO 100,000 shares due to options he or she is going to exercise, you're going to need stock to be able to give them. So you may need to repurchase some of your own shares to use those shares for when options are exercised. So these are all reasons that companies will do stock repurchases. It's also going to reduce the amount of ownership dilution. It's going to reduce the amount of shares out there, less pieces of that ownership pie. So some advantages, stockholders can tender or not. You do not have to sell your shares if a repurchase is announced, but you can. They'll announce a price, and if you want to sell your shares, you can. It helps avoid setting a high dividend that can't be maintained. Repurchase stock can be used in things like corporate takeovers or resold to raise cash in the future if we need. We can remove a large block of stock overhanging the market and depressing the price. Remember supply and demand. If there's too many shares out there, the price is going to be reduced for that reason. If we remove those shares, the price should go up. And stockholders may take it as a positive signal. Generally, management will repurchase stock when they think it's undervalued. If you know your stock is trading way more than it should, you would never really want to repurchase it unless in some case of an emergency to meet an options obligation or something like that. So overwhelmingly, if a company is buying its own shares back, they think it's undervalued. You would not want to buy your shares back if you think they're really overvalued. And finally, what are some disadvantages of them? They may be viewed as a negative signal. The firm has poor investment opportunities, so it's got all this cash. What are we going to do with it? We might as well buy our stock back and raise our stock price that way. So if they do this really often, it could be seen as a negative signal that the firm just has no other use for its cash. The IRS could impose penalties if repurchases were primarily to avoid taxes on dividends, so keep that in mind. Selling stockholders may not be well informed, so you may not be informed why the company's doing a buyback, and your stock may be very undervalued, and if you sell it back, you may lose out and therefore be treated unfairly. And firms may have to bid the price up to complete the purchase and may wind up paying too much for its own stock. They may have to offer more and more to get enough shares to meet whatever need they're trying to do, and may wind up overpaying for their own stock. So stock repurchases are another way a company can use its profits to affect its stock price and, in theory, return wealth to the shareholders. So that's going to take us to the very end of the chapter, slide 24 of chapter 15, and that's going to be it for chapter 15.